If you do BRRRR method investing, Airbnb, or any type of long-term hold strategy in real estate investment, you're going to adore this video. DSCR loan rates by credit score and what debt consolidation actually saves you. So this video is going to be a deep dive into how your credit score functions as a pricing mechanism in DSCR lending and how strategic debt consolidation can move you across their tier lines that determine your rate. So let's get fair up it. Your credit score is a price tag, not just a strict gatekeeper. So how DSCR qualification works. A DSCR loan qualifies you off the property's rental income, not your personal tax returns. And that does not mean your credit score stops mattering. It just changes jobs. Now, in DSCR lending, your score sets your price, not your approval. However, there is a minimum limit, obviously. We'll get into that in a sec. But what this means for investors, unlike conventional loans like mortgages, you won't be disqualified because of complex personal income like your DTI, but every point on your credit score is quietly working in the background, determining the interest rate tier your file lands on and ultimately how much you pay over the life of the loan. So let's take a closer look. The actual pricing ladder. According to DSCR Capital Partners and PeerSense, non-QM pricing tiers break at roughly every 20 to 40 points on your FICO. So it isn't a smooth curve, it's a ladder. Now, 620 entry, bare minimum at very lenient lenders. 660, going to jump you up 0.125 to 0.4%. And as you can see, it's just going to jump up each and every time. And the best pricing starts at 760. So each tier step is worth 0.125 to 0.375 on the same file. Which rung you land on depends entirely on which side of these exact numbers you sit. Now, the real dollar math, let's actually break it down over the term of the loan. According to those DSCR Capital Partners, the spread between 760 score and a 660 score can run 1.25 to 1.75 in rate. And here's what that actually looks like on a real loan. So $278 a month, the difference between a 6% and a 7.5% rate on a 300K loan, that's $3,300 a year, annual cost of sitting one tier below your potential on a single property. 1.75% max rate gap, the spread between a 660 and a 760 score on the same DSCR file, the same property. So why this compounds across your portfolio? It's not a one-time saving. Investors are rarely financing one property. The same rate, the pricing tier your file lands on today follows you into every future DSCR loan. The multiplier effect, a single utilization cleanup, which is debt consolidation, that pushes you across one tier line, pays out on every DSCR loan that comes after it. So it's not just on the current deal. The compounding value of one score improvement is significant across a growing portfolio. So how debt consolidation gets you across a tier line? Consolidate balances, roll revolving balances into an installment loan. So this looks like someone with maxed out credit cards, high utilization, above 50%. If we can get that down below 20% utilization, your score is typically going to jump 40 to 80 points in a single reporting cycle, less than 30 days. Rolling revolving card balances into a fixed installment loan drops utilization immediately and can move a score 40 to 80 points in a single reporting cycle. And that's often enough to cross one, sometimes two of those pricing tier lines outright. It's the fastest lever we can pull for boosting our FICO score because utilization accounts for 30% of our FICO score. So the reserve connection, according to NASB, DSCR lenders commonly hold roughly 9 months of PITI in reserve. Principal, interest, taxes, insurance, and association dues. A stronger FICO score is one of the few levers that reduces how much of that reserve requirement applies to your file. The same consolidation move that improves your rate also eases the reserve math, giving you a dual benefit from a single strategic action. So a lower rate, cross a tier line and reduce your interest rate. Easier reserves, a stronger FICO reduces the reserve requirement burden on your deal, enabling you to take on more deals at once, and one move, two wins. Debt consolidation delivers both benefits. simultaneously in one reporting cycle, not to mention the increase in FICO to go and get other lending tools, to go and get other funding tools on our 5-tool stack, like HELOCs, business lines of credit, term loans, credit card stacking. These all become available to bridge these gaps as well. Not to mention you've got smaller gaps now because the reserve requirement. The recap. This is not a story about getting out of debt. It's a story about which pricing tier your file lands on and whether that lands before or after you have cleaned up the number the tier is based on. So credit score equals pricing, not approval. DSCR loans qualify on rental income. Your score determines the rate tier. Tier lines are exact. So it's a ladder, not a smooth curve. So we want to see if we can cross some of these boundaries, the 620, 660, 680, 700. Consolidation is the lever. One utilization cleanup can move your score 40 to 80 points across multiple tiers, and it compounds. Every future DSCR deal benefits from the tier improvement you make today. So let's map your deal. If you want to know which tier line your file is sitting closest to, the next step is simple. Let's map out exactly where your score lands on the pricing ladder and what it could take to move it up to the next tier or even jump to. Head to gapfunded.com/apply to map your deal and find out which tier line you're closest to crossing. Identify your tier, model the gap, execute the move. Worst case, you walk away with a full game plan and how to step through the process. I'm Mick Wadley, founder of Gap Funded. Let's go close something. If you adored this video, smack the subscribe and flog the bell, and I'll see you on the next one.